Breaking news is ripping through the US auto market right now, and it's coming from a company that almost never panics, never blinks, and never discounts aggressively unless something big is happening behind the scenes. Toyota has just dropped a pricing bombshell on its truck lineup, rolling out massive discounts that are sending shockwaves through dealerships, rival automakers, and Wall Street analysts alike. This is not a routine year-end incentive or a quiet regional rebate. This is a strategic move that signals stress, opportunity, and a major shift in how the truck war is about to be fought in America. For decades, Toyota trucks were the last ones to go on sale. Tacoma and Tundra buyers paid sticker, sometimes above it, because demand always outpaced supply. Dealers had leverage, buyers waited months, and Toyota enjoyed ironclad pricing power. That's why what's happening now is so alarming. We're talking about thousands of dollars off MSRP, 0% financing offers, dealer cash stacking with factory incentives, and lease deals that suddenly undercut Ford, GM, and Ram. When Toyota breaks its own pricing discipline, it's not generosity, it's calculation. So why now? The answer starts with inventory. US dealer lots are quietly filling up, not just with domestic trucks, but with Toyotas that were supposed to sell instantly. Higher interest rates have crushed monthly affordability, truck prices have surged past what working buyers can tolerate, and demand has softened faster than automakers expected. Toyota sees the data in real time. They see loan approvals falling apart, buyers walking away at finance desks, and competitors slashing prices to move metal. Waiting is no longer an option, but this isn't just about clearing inventory. This is about market share warfare. Ford is already bleeding margin on F-150 incentives. GM is sitting on tens of thousands of unsold Silverados and Sierras. Ram has openly admitted demand is weaker than forecast. Toyota knows that trucks are the profit backbone of every US automaker, and by attacking pricing now, they force rivals into a brutal choice: match the discounts and destroy margins, or hold prices and lose buyers. Either way, Toyota wins. What makes this even more disruptive is where the discounts are landing. These aren't stripped work trucks nobody wants. We're seeing incentives on mid-level trims, popular configurations, and high-volume models that normally never need help. Tacoma discounts are particularly shocking, especially as buyers wait for refreshed competitors and cheaper alternatives. The message from Toyota is clear: buy now, not later, and buy Toyota, not Detroit. Dealers are feeling it too. Toyota dealerships have long enjoyed premium positioning and fast turn rates. Now they're being told to move inventory aggressively, advertise price cuts loudly, and compete head-to-head with domestic brands on affordability. That changes the entire showroom dynamic. It also pressures used truck prices, because when new trucks get cheaper overnight, trade-in values and resale expectations collapse just as fast. This is where the ripple effects begin. Once Toyota moves, the rest of the industry has no choice but to react. Incentive wars escalate quickly, financing arms get stretched, residual values take a hit, and consumers who bought trucks at peak prices suddenly realize the market has shifted under their feet. We've seen this pattern before, right before major corrections. And here's the part nobody is talking about yet. If Toyota, the most disciplined automaker in the industry, is discounting this hard now, what happens if the economy slows even a little more? What happens if interest rates stay higher for longer? What happens when 2026 models arrive and 2025 trucks are still sitting on lots? This move isn't just a reaction to today's market, it's a defensive strike against what Toyota sees coming next. Because once the price floor breaks, it never snaps back overnight. Buyers reset expectations, dealers lose leverage, automakers chase volume instead of profit, and the entire truck market starts to look very different from the one we've known for the past decade. Right now, Toyota has lit the fuse, and the explosion hasn't fully hit yet, but you can already feel the pressure building across the industry as competitors scramble. Analysts revise forecasts, and buyers realize that waiting might suddenly make a lot more sense, especially as more incentives begin to surface. And the real battle for America's truck buyers is only just beginning as the next wave of pricing moves starts to emerge from the very competitors who once dismissed Toyota as conservative and slow to react. Ford, GM, and Stellantis are now being forced into a corner where every move they make risks exposing deeper weakness. If they match Toyota's discounts, they admit demand is softer than publicly stated. If they don't, showroom traffic leaks away day by day as buyers follow the lowest monthly payment, not brand loyalty. In today's market, loyalty collapses the moment affordability disappears. What makes this moment even more dangerous for the industry industry is timing. This is not happening during a recession headline or a financial crisis panic. This is happening while automakers are still publicly talking about resilient demand and strong consumer interest. Toyota's actions quietly contradict those narratives. Pricing is the truth teller in the auto business, and price cuts this aggressive reveal stress long before earnings calls ever do. Insiders know this. That's why investors are watching Toyota's move far more closely than any press release. There's also a psychological shift underway among buyers. For years, consumers were trained to accept markups, forced add-ons, and take it or leave it deals. Toyota discounting breaks that mindset instantly. When the most in-demand truck brand starts negotiating again, buyers everywhere begin to push back. They delay purchases, they cross-shop harder, they wait for even better deals. That hesitation alone can slow the entire market, forcing even more incentives to appear. And let's talk about financing, because this is where the pressure really compounds. Even with discounts, monthly payments remain high by historical standards. That's why Toyota isn't just cutting sticker prices, it's leaning heavily on subvented financing and lease support. That costs money. Toyota can absorb it better than most, but the message is unmistakable. Moving units now matters more than preserving short-term margins. That is not a decision made lightly. Behind the scenes, suppliers are watching nervously. Truck production supports thousands of parts manufacturers, logistics firms, and assembly jobs. If incentives fail to spark demand fast enough, production schedules get adjusted, shifts get cut, and the pain travels down the supply chain. We've already seen this movie play out with other automakers, and Toyota is clearly trying to avoid being dragged into the same spiral by acting early and aggressively. Another layer to this story is what it means for upcoming models. Toyota has future trucks and refreshes lined up, and they know older inventory becomes toxic the moment new models arrive. Clearing lots now, even at the cost of incentives, protects future launches from being overshadowed by discounted leftovers. This is inventory triage, not desperation, but it still signals how fragile the balance has become. And don't ignore the used market impact. When new Toyota trucks get cheaper, used prices soften immediately. That hurts recent buyers, strains lenders, and increases negative equity risk. Once negative equity spreads, it becomes even harder for consumers to trade up, slowing the market further. This feedback loop is exactly what automakers fear, and Toyota is trying to manage it before it spins out of control. What we're witnessing right now is the early stage of a broader reset. The post-pandemic pricing era is cracking, and Toyota just made that crack impossible to ignore. The question now is not whether other automakers will respond, but how far they'll be forced to go, and how quickly buyers will realize that patience may unlock even bigger discounts as this pricing battle deepens, and the next moves begin to surface across showrooms nationwide as the industry quietly braces for what comes next. Because once a price war begins, it rarely stays contained to a single segment or a single quarter. The truck market is deeply interconnected, and Toyota's move is already bleeding into midsize, full-size, and even commercial fleets that were once considered insulated from consumer demand swings. Fleet buyers are renegotiating contracts, rental companies are pausing orders, and large buyers are suddenly asking for concessions that would have been unthinkable a year ago. This puts enormous pressure on production planning. Automakers build trucks months in advance based on demand forecasts that assume stable pricing and strong absorption. When discounts explode overnight, those forecasts become obsolete. Plants can't shut down instantly without massive costs, but building too many trucks in a discounting environment only deepens the problem. Toyota's early move suggests they see this cliff approaching and are trying to sprint ahead of it while others are still walking. There's also a global dimension that most people miss. US truck pricing influences markets worldwide, from export values to component sourcing and even currency exposure. Toyota operates on a global scale, and instability in its most profitable market forces adjustments everywhere else. That's another reason this isn't a casual decision. When Toyota moves pricing in America, factories, suppliers, and executives across multiple continents feel it. Consumers, meanwhile, are starting to notice something feels different. Dealer lots look fuller, salespeople are calling back, emails and ads are more aggressive. Incentives that used to come with fine print are now front and center. That shift changes behavior. Buyers who were priced out last year are re-entering the market, but they're also more cautious, waiting to see if the next discount wave is even bigger. That hesitation slows momentum, and slow momentum demands even more incentives. Competitors are now trapped in a reactive posture. Ford and GM can't publicly admit weakness, but internally they are running scenario models on how deep discounts might need to go to protect volume. Stellantis is already under strain, and Toyota's move raises the floor of pain for everyone else. The longer this drags on, the more brutal the math becomes, because fixed costs don't disappear just because prices fall. What's especially telling is that Toyota is acting before any official crisis narrative has taken hold. This is preemptive. It's a recognition that the old assumptions no longer hold. High prices, high rates, and stretched consumers are not a temporary glitch. They are structural pressures. Toyota is choosing to adapt early rather than defend an unsustainable status quo. And once adaptation begins, it rarely reverses cleanly. Buyers anchor to new price expectations. Dealers adjust commission structures. Lenders recalibrate risk. Even after conditions improve, the memory of discounts lingers. That's how eras in the auto industry end, not with a crash headline, but with a slow realization that the rules have changed. Right now, we are standing at that inflection point. Toyota has fired the opening shot, and the echoes are spreading through every corner of the US auto market. The next moves from rivals, lenders, and buyers will determine whether this becomes a controlled reset or a cascading collapse. And the signals are already forming as more incentives quietly appear, more inventory stacks up, and the industry edges closer to a moment that could redefine truck pricing in America for years to come as the pressure continues to build and the story keeps unfolding. Even further as the underlying economics become impossible to ignore. Truck prices didn't just rise because of demand. They rose because automakers stacked content, chased margins, and assumed buyers would stretch indefinitely. That assumption is now breaking down in real time. Toyota's discounts are an admission that the ceiling has been hit, and once a ceiling cracks, the fall can be faster than anyone expects. Dealers are now quietly adjusting tactics. Instead of holding firm on price and pushing add-ons, many are shifting to volume conversations, prioritizing turnover over per unit profit. That is a dangerous but necessary pivot when floor plan costs rise and inventory ages. Every extra day a truck sits unsold costs money, and Toyota's incentive structure is encouraging dealers to move fast rather than wait for a mythical return of peak demand. This also creates tension between dealers and manufacturers. Incentives help, but they don't erase all the pain. Dealers who took inventory at higher costs are suddenly expected to discount aggressively, compressing margins they were counting on. That strain can fracture relationships, especially if this pricing environment persists longer than anticipated. Toyota traditionally manages dealer networks carefully, which again underscores how serious this moment is. Another critical factor is consumer debt. Many truck buyers are already carrying long-term loans with high balances. When prices fall, trade-in values follow, and that traps owners in negative equity. Those buyers can't easily upgrade even with discounts, which caps demand. Toyota's move helps new buyers, but it also reveals how fragile the existing ownership base has become after years of inflated pricing. We're also seeing a generational shift in buyer behavior. Younger buyers are far less willing to overpay for brand prestige or wait months for delivery. They compare payments instantly, switch brands easily, and delay purchases without hesitation. Toyota discounting acknowledges that reality. Winning this generation requires competitive pricing, not reputation alone. At the same time, commercial and small business buyers are reassessing capital spending. Trucks are tools, not status symbols, and when costs spike, purchases get delayed. Discounts can unlock some of that demand, but only if buyers believe prices have stabilized. If they think prices will keep falling, they wait. That's the paradox Toyota and the entire industry now face. All of this feeds into a larger question about sustainability. Can the industry maintain current production levels at lower prices without widespread cutbacks? Can suppliers survive thinner margins? Can lenders manage rising risk? Toyota's early move suggests they are trying to control the descent rather than be forced into a panic later. What's unfolding now is not a single promotion or a temporary sale. It's a recalibration of value, affordability, and expectations. Once recalibrations begin, they ripple outward, touching employment, investment, and even regional economies tied to truck manufacturing. The stakes extend far beyond the showroom, and as more data rolls in, more incentives surface, and more buyers hesitate, the gap between public optimism and market reality continues to widen, setting the stage for the next phase of this story, where the consequences of Toyota's bombshell pricing moves start to materialize in ways that few are openly prepared to discuss. As the industry moves deeper into uncertain territory and the pressure shows no sign of easing. across earnings reports, dealer meetings, and internal forecasts that were built for a very different environment. Executives may avoid dramatic language in public, but internally the conversation has shifted from growth to containment. Toyota's discounts have effectively forced the entire industry to stress test assumptions that were once considered safe, especially around pricing power and consumer resilience. One of the most revealing signals is how quickly incentives are being normalized in marketing. What used to be framed as limited time offers are now becoming ongoing selling points. That normalization erodes urgency and trains buyers to expect deals as a baseline, not a bonus. Toyota understands this risk, yet still move forward, which tells you how pressing the situation really is. They are choosing the lesser of two evils, controlled discounting now versus uncontrolled collapse later. We're also starting to see cracks in regional markets. High-cost urban areas are seeing sharper slowdowns, while rural and industrial regions tied to truck usage are more cautious than before. This uneven demand makes national pricing strategies harder to manage. Toyota's broad discounts suggest they're smoothing those disparities rather than fighting them dealer by dealer. Another underappreciated factor is competition from outside the traditional players. Lower cost imports, new compact trucks, and even alternative mobility options are siphoning off buyers who once would have stretched for a full-size pickup. Toyota's move is partly defensive against that encroachment. If a buyer can get a Toyota truck for closer to what they expected to pay, they're less likely to defect to a smaller or less established option. At the same time, technology costs continue to rise. Emissions systems, safety mandates, and electrification investments aren't getting cheaper. Discounting squeezes the very margins that fund those future requirements. That tension creates a long-term risk. Either prices eventually rise again, or production volumes shrink. Toyota's scale gives it more flexibility than most, but even they are not immune. What's striking is how quiet this all feels on the surface. There's no dramatic collapse headline yet, no sudden shutdown announcement tied directly to trucks. Instead, there's a slow, creeping adjustment that only becomes obvious when you step back and connect the dots. Toyota's pricing bombshell is one of those dots, and it's a big one. As buyers absorb this shift, their strategies change. Some rush to lock in deals before incentives disappear. Others hold back, convinced this is just the beginning. That split behavior adds volatility to sales data, making it harder for automakers to read the market and plan accordingly. Volatility is the enemy of efficiency, and inefficiency raises costs even further. The longer this environment persists, the more it reshapes industry behavior. Hiring slows, investment gets delayed, product plans get reconsidered. None of that happens overnight, but it starts with decisions like the one Toyota just made. Price cuts are not just financial tools, they are signals of strategic recalibration, and as these signals accumulate, the industry moves closer to a tipping point where today's discounts become tomorrow's expectations, and tomorrow's expectations force even bigger structural changes, pushing the truck market into a phase that looks nothing like the past decade, with consequences that are still unfolding and setting up the next chapter of this story as the tension continues to rise and the path forward grows increasingly uncertain. The final pressure point to watch is confidence. Truck sales thrive on confidence in income, resale value, and long-term stability. When prices swing this sharply, confidence weakens. Buyers start asking different questions, not just about horsepower or towing, but about depreciation, loan risk, and whether waiting 6 more months could save them thousands. Toyota's discounts may move units today, but they also accelerate this shift in buyer psychology, where caution replaces urgency across the entire market. At the manufacturer level, this moment forces hard prioritization. Not every plant, trim, or configuration can be protected if pricing continues to soften. Automakers will quietly favor high-volume, high-efficiency models and let weaker variants fade away. That reshaping of lineups doesn't make headlines immediately, but it changes what trucks are available, how they're priced, and who they're built for. Toyota's action is an early indicator that those internal sorting decisions are already underway. Zoom out far enough, and this becomes bigger than trucks. The US auto industry has been leaning on high-priced vehicles to offset rising costs and fund future technology bets. If trucks, the most profitable segment of all, lose pricing power, the entire financial structure gets tested. Toyota dropping this bombshell is not an isolated event. It's a stress signal for the whole system, hinting that the era of easy profits and unquestioned demand may be ending faster than many expected. So make no mistake, this isn't just about a few $1,000s off a Toyota truck. This is about a market that's shifting under everyone's everyone's feet. When the most disciplined automaker in the world chooses to discount aggressively, it tells you something fundamental has changed. The next moves from rivals, the next reaction from buyers, and the next wave of incentives will determine whether this becomes a temporary correction or the beginning of a much deeper reset. One thing is clear, the US truck market has entered a new phase, and anyone paying attention can see that the shockwaves from Toyota's decision are only just beginning to spread.